Many retail traders sit at their desks, staring at candlestick charts, trying to predict where a currency pair will move next. They treat these lines like a puzzle to be solved in a vacuum. But treating the Australian dollar to Canadian dollar pairing, the AUD-CAD, like a math problem will wipe out your account. This is a commodity cross. Its value is anchored to heavy machinery pulling physical resources out of massive holes in the ground across the globe. Take the Australian economy. It relies heavily on extracting raw materials, specifically iron ore, and shipping them out to feed massive manufacturing hubs. On the other side of the trade, you have Canada. Their economic engine runs on North American energy demand, making them one of the world's top producers of heavy crude oil. Hitting buy or sell on the AUD-CAD is a direct bet on the outcome of a global tug-of-war between Australian iron ore and Canadian crude. Institutional traders know this. They don't guess. They use a precise three-layered filtering playbook to strip away the market noise and pinpoint high-probability setups. Let's break down exactly how they do it. The first layer of this playbook is establishing your directional bias. You have to know which country's primary export is currently dominating the global market. This diagram shows our two core benchmarks. On the left, we track West Texas Intermediate, or WTI crude, for Canada. On the right, we monitor global iron ore futures for Australia. You are looking for these two lines to diverge. For example, if global demand pushes WTI crude prices significantly higher, while an economic slowdown in China causes iron ore to collapse, you have a clear imbalance. Strong oil strengthens the Canadian dollar, and weak iron ore hurts the Australian dollar. This specific imbalance gives you a strong baseline bias to short the AUD-CAD pair. You have your foundation, but executing a trade right now based purely on commodities is a mistake. We have to look at the macroeconomic headwinds that could ruin the setup. Commodities drive the long-term trends, but central banks control the steering wheel. Their policies cause immediate, violent price shifts. Two major players control this volatility: the Reserve Bank of Australia and the Bank of Canada. Their primary weapon is the interest rate. If the RBA is aggressively hiking rates to fight inflation, while the BOC is cutting theirs, global capital will flood toward Australia to capture that higher yield. When that flood of capital hits, it simply doesn't matter if iron ore is plummeting or oil is soaring. The central bank capital flow will completely overpower the commodity data. That is why you must check the upcoming economic report card, inflation data, employment numbers, and scheduled rate decisions. You need absolute certainty that a central bank isn't about to announce a surprise pivot that blows up your setup. Only after you have a clear macroeconomic runway do you open your trading platform. Technical indicators aren't here to tell you what direction to trade. They are here exclusively to time your entry. This chart shows the 50 and 200 period exponential moving averages. These lines smooth out price action over time to confirm the broader trend. To validate our short bias, we want to see the current price drop completely below both of these moving averages. That tells us the market momentum officially aligns with our fundamental data. In the lower panel, an oscillator like the RSI can signal an exhausted temporary rally. When that RSI turns down from overbought territory right as the price breaks through a key horizontal support level, you have your entry trigger. Institutional traders pull the trigger when these three layers, the commodity baseline, the central bank policy, and the technical breakdown, align perfectly. Even the most aligned setups fail. Trading commodity-linked pairs carries unique set-in risks that require strict capital protection. A single decision at an OPEC press conference to cut oil production can send crude prices soaring in seconds. A sudden labor strike at an Australian port can freeze iron ore exports overnight. These geopolitical flashpoints bypass technical charts entirely. To survive them, your exit strategy has to be completely rigid. This chart compares two exit strategies. Amateurs often place their stop loss at an arbitrary 20 pips away, getting knocked out by normal volatility. Intelligent placement hides that stop safely above the most recent structural high. Once that structural level is set, the math takes over. You calculate your position size so that if the trade hits that stop loss, you only lose exactly 1 to 2% of your total account capital. By stacking these filters, you stop seeing the AUD-CAD as random letters bouncing inside a vacuum. It becomes a readable, dynamic reflection of the global economy. Step out of the vacuum. Test this multi-layered institutional framework using real-time intermarket data by opening a free demo account with FXNX today.